about right here. Shares outstanding, 4.32 billion. So that would be hence EPS will be 10,772. I can calculate it in Excel, but I'm gonna go ahead and do it in my phone. $2.4935, hence if I haven't made a calculation mistake somewhere. Oh, you guys are not telling me that I'm an idiot. Wow. What did I do wrong? I calculated the EPS for Coke instead of Pepsi. So I need to go to Pepsi. The reason I knew I was wrong, I know Pepsi price is somewhere around 150 plus. Even though this method is not necessarily a good method, it shouldn't be that off when you're comparing Pepsi and Coke. So let's basically redo it. Quarterly, 8290. Thank God we have an eraser. Number of shares. Come on. I hate this. Unfortunately, I can't control these lights anymore in this room. 1.37 billion. $8290 divided by 1370. 605.11. Compared to current price of Pepsi, about 161. You know, taking this approach seriously, we can, you know, both of them are publicly traded. We could suggest that Pepsi is indeed overvalued, okay? Or Coke is undervalued relative to Pepsi. So if I were to make a trade, suppose I'm a hedge fund, based on this idea, I would buy Pepsi. I would buy Coke and short Pepsi. Anybody here who doesn't know what shorting means? It's okay. Shorting any security means you're betting that its price is going to go down. And by the way, that's all legal. You can borrow somebody else's securities, sell them in the market. Obviously, you give them some collateral. Later on, if and when the price drops, you buy it back and you pay off your stock loan, you're done. You still buy low, sell high, but in shorting, you sell first, then you buy. In regular so-called long positions, you buy first, then you sell. That would depend upon what would be our interpretation of PE, okay? And what are some shortcomings with it? First and foremost, the number that we have used here is a backward-looking one, okay? It says the way to think about PE is if earnings were to remain at their current level, how long would it take us to recover our investment? So think about Coke. Let's go back to Coke, since we use that as comparison. Coke's price is about $56. And it has a PE of 22.6 or 36. Obviously that changes as the price changes, but earnings per share is $2.47, okay? So if earnings were to remain at their level during the last 12 months, you're gonna have to wait about 22 and a half years to recover your investment in terms of earnings. After that, you'll start making money. And this is not even on a discounted basis, so we're not even going there yet. What's the crucial assumption here in this interpretation? What's one shortcoming you can see? Seeing PE as a kind of a payback period number. What am I assuming? I just told you what I was assuming, so. Huh? No. I'm assuming that earnings are going to remain at their current level. Okay? That typically is not true. And, if they were to remain on average at their current level, I can live with that too. I'm not necessarily worried about some sort of variation on that number. But firms do grow in general, and they may be growing at differential rates, okay? So if you were to trade based on PE, it's a backward-looking number. It looks at the earnings last year, but we're going to deal with that. That's not that difficult to deal with. And B, it assumes that there is no growth differential between two firms. They're going to grow at the same rate. Well, that's typically not true. Among other places, in FinanceYahoo.com, you can, under Analysis tab, come on, at the very bottom, there are growth estimates. For example, analysts expect that Coke, in this case, the growth estimate is for earnings. Coke is going to grow about 5.2% next year. If you think about the growth rate of the economy plus inflation, that's not an unusually low or high growth rate. And they also expect about slightly less than 6% over the next 5 years on average. Let's look at Pepsi. Analysts are actually expecting that Pepsi is going to grow about 8% next year and slightly above 8% over the next 5 years. Immediately we say, okay, we expect Pepsi to grow faster than Coke. Yes, currently the based on PE comparison alone, we think that Pepsi is overpriced, but that is based on crucial assumption that growth rates are going to be similar. We see that they're not. Yes.
Requires a little bit of explaining. So my boss and I were working on setting up
A little bit higher.
yeah.
Remember, I'm old.
My boss and I are working on setting up a stock portfolio.
Mhm.
So I've been working on with it. He wants things that don't have too high of a price to earnings because he's stating that affects the longevity of dividend for their investments or for investors.
Not that I necessarily agree with that assessment, but go ahead.
What are your thoughts on it? Like, why would you argue against that kind of policy?
Which is going to be very clear soon. Not wanting a very high PE ratio is not necessarily a negative sign for a stock. It depends. I mean, for example, for Pepsi, let's go to stats. Their PE ratio is 2660, okay? It's not too high. Pepsi is kind of an established company, same as Coke.
He's looking for some at exactly that level. He's also looking at getting into like cloud companies like NVIDIA.
For example, let's look at the PE for, let me see, NVIDIA.
Our number at the very high.
It is very high. Where art thou? Okay, trailing PE is 97. You're thinking, man, it's going to take me 100 years to recover my investment. But is it? Let's look at the growth estimates for NVIDIA. These guys' earnings grew 200% this year, on average 37% during the past 5 years. In fact, next year they're expected to grow 57, over the next 5 years 75%.